Hi everyone, my name is Sue and this is Decoding FX, where we learn how to make money work for you and not the other way around. In this episode, I want to talk about what's been happening in the banking industry. As some of you guys might know, there has been a recent implosion of small regional banks. I say small, but they're still one of the top 20 biggest banks across the nation. And as some of you might guess this is SVB, which stands for Silicon Valley Bank, as well as Signature Bank, which is based in New York. Now, what's been going on with SVB and how does it affect everyday customers? Not talking about big tech startups with over $250,000 worth of deposits, but what is really happening? How did it happen? And how does it affect everyday customers like you and me? Let's get started. So first off, let me start by explaining who is SVB, how did the implosion happen, and what can we do next as everyday customers. So SVB, again, stands for Silicon Valley Bank. They were a very popular tech startup bank that is based in Santa Clara in California, which kind of is confusing. A bank that's been around for 40 years suddenly implodes and the FDIC had to step in. So who are the FDIC? They are an independent agency of the US government that protects the bank depositors. They're the ones who step in to make sure that if banks have to owe money back to the people who put it in, then they're the ones stepping in to make sure that you can actually withdraw your money. Because if you can only put money in and you can't take it out, that's not really trustworthy. So the FDIC stepped in, make sure that the SVB Bank could pay back its bank deposit, the people who put money into the bank. So what went wrong is kind of a similar scenario. For those of you who watched The Simpsons, this cartoon practically forecasted what could potentially happen when there is a massive bank run. What is a bank run? A bank run is what happens when couple or several individuals go to the bank and withdraw large amounts of money, like almost like a panic withdrawal. Except in this scenario, the folks who withdrew a ton of money from SVB are actually venture capitalists. They are institutional firms with a ton of money, and they usually invest it in some shape or form. Except in this scenario, they were monitoring the financial statements of Silicon Valley Bank and then were not reassured at the direction Silicon Valley Bank was going. So what did they do? Just like anyone who's afraid of losing their money, they went to the bank and withdrew a large amount. I think it was approximately $42 billion. Now, I don't know about you, but that is a huge amount. And then with the way our communication is so prevalent now in social media, Twitter, Instagram, whatever, the folks who withdrew that large amount at Silicon Valley Bank also reached out to their internal network, telling them like, hey, I'm kind of worried about Silicon Valley Bank. If you are also worried about your money, I suggest you pull out your money right now. Hence, the bank run. Because they went to the bank and withdrew a large amount of money that Silicon Valley Bank wasn't prepared for, as well as Silicon Valley Bank was not prepared for everything that's happening in the financial space, they basically imploded. They didn't have the cash reserves, and so they basically had to shut down. The FDIC had to get involved, save them from affecting every other financial institution across the nation. The whole thing could go down. It only starts with a small ripple effect, and then everything affiliated with the financial banking system could also implode as well. Yes, in the news, you've probably been seeing headlines where like, oh, this is all caused by looming fears of recession, high interest rates, the Fed hiking rates continuously. But at the same time, it was caused by a bunch of people who got afraid. That's basically it. They were afraid of where their money was going. They didn't like it. Because they were afraid, they took it out, which caused a whole snowball effect. Now, how does this affect everyday customers like you and me? Well, it kind of goes back to the idea of making sure your eggs are not all in one basket. The FDIC insurance is $250,000. If you have anything less than that, most folks don't have more than $250,000, then you should be rest assured that the government will bail out and make sure that you have funds in that account. But again, if you are freaking out, then I would highly suggest you move some of your funds to a bigger bank. Spread out your funds. Don't have them all in one account, because to be rest assured and to be for your sake of mind and your sanity, I would spread out your funds. I bank with a credit union and they have not let me down so far, but I wouldn't keep all my funds in one account. I mean, yes, they have this legacy. Yes, they've been around for so long. Silicon Valley Bank was around for 40 years. Wells Fargo, Chase, Bank of America, Citibank, they've been here for over 100 years. But even a 100-year legacy, if things go wrong due to human negligence or just in order to protect yourself, please diversify. Please spread your funds across multiple accounts if you feel safe doing so. It doesn't have to be a lot. You could have 1 to 3 different accounts. I would say 1 to 3, don't go crazy, but it helps diversify. What's next for Silicon Valley Bank? Well, FDIC has stepped in and they will be taking care of that bank going forward, and they will be bailing out that bank. Nobody likes the word bailout because based on 2008 financial crisis, bailout just means that the government is letting these banks be loose with their financial policy, with their regulations. So nobody likes the word bailout, but to be perfectly honest, this is a bailout. It might be a special type of bailout, but it is a bailout. Bailout is nice in the fact that the everyday consumer doesn't have to worry about where their money is, but that gives me not so good vibes about what is happening. I think this should be the opportunity for the Fed or the government or these big financial institutions to really take a step back and look at what they have done. The fact that an SVB, which is the 16th largest bank, was able to do this and implode even after being around for 40 years means something is lacking in the regulations. They need to revisit this. I mean, there's a lot of blaming fingers and everything, but at the same time, maybe this is time for a change. Maybe this is time that folks need to revisit about what they're doing and how this started in the first place. So I hope this was helpful in understanding how the Silicon Valley Bank implosion happened. And I hope that you guys feel a little bit more reassured that even if banks do collapse, there is some regulation stepping in, some insurance so that you can still get your funds out of these accounts. And if you're still not rest assured, leave a comment down below and let me know what you're feeling right now, because not gonna lie, this was scary. Just finding out that a bank could just implode like this is not fun. Give me a thumbs up if you liked the video, and I appreciate your support, and thank you for everyone who has subscribed so far. Thank you again for watching, and I'll see you in the next one. Thanks. Bye.